So far, we've talked about purchases of inventory, and now we're going to talk about the sale of inventory. And we've kind of already done this earlier, so I filled in the first couple parts. But if I'm buying those iPads from Apple and I'm SIUE, the idea is I'm the bookstore, I'm going to sell them to somebody else. Say I have a contract with Alton Public Schools to sell them 10 iPads on account. So on account tells you it goes to accounts receivable, and we have sales for 10 times 500 or 5,000. In a perpetual inventory system, and in the prior lectures, we know that it would be the cost of goods sold and the inventory would be the second entry made. And if you remember, our final cost for our iPads was $299, really $299, 10 cents, but we'll make it $299 for those 10. And so you can see again, our sales minus our cost of goods sold would be our gross profit. But what if instead of just selling them and expecting $5,000, what if instead, and so this is kind of an or, what if instead of just selling them, we have those terms? Because again, if I can buy something 210 net 30, I could also have terms when I sell things. It encourages them to pay early so you get the cash. So we tell our customers if they pay quickly, they get a discount. Let's say that we give them terms 315 net 30. Remember, that means they get 3% if they pay within 15 days or net 30. Now, when we make the sale entry, we assume everybody's rational and 3% is worth it. And if they've got the money, they're going to try to get it to us. So we're going to still make the entry for accounts receivable and sales, but we're going to do it for the net amount because we assume everybody really pays that. I've got that $5,000, and also remember up here, $5,000 selling price we're worried about. Now we don't care about that inventory side. We care about the sales. 5,000 times 0.97, or 100 minus 3, 1 minus 3, is $48.50. So that's really all I expect to collect. So that's what I'm going to book as my accounts receivable and my sales. When they pay within the discount period, their accounts receivable goes away for the $48.50, and that's how much cash we're going to get. And again, this one's another or, but what if Alton does not pay within the discount period? Then the cash we're going to get is $5,000, but that's going to clear their accounts receivable. So accounts receivable still has to go down by $48.50 because that's all the accounts receivable was up here. So I've got to take that account to zero. So I got another 150 here, which is that little 3% of 5,000. Got to put that into an account. We're going to call that sales discounts forfeited. We're going to say, for some reason, they couldn't get their act together and pay in time, and so they forfeited their discount. What kind of account is sales discount forfeited? Notice it has a credit balance. You can go, okay, it's a credit balance, either a liability equity or a revenue account. It's a revenue account because we actually sold those for an extra $150. So it is a revenue account. But on our financial statements, we're going to put it a little separate. We don't want to put it with our sales, that top line revenue. That's going to go down under other revenue on the income statement. So not add it to sales. And this is something they knew. If you took this course a couple years ago and you're repeating it, hopefully you're not in that situation. That's going to go under other revenues because we want to keep it separate from what we sold things for. By delaying the payment, it's like they had to pay some interest for not getting it done in the 15 days. It's a revenue account. That's the easy part. When we get to financial statements, it shows up separate from your sales. Why does FASB require SIUE to assume that everybody takes the discounts. We're more, this is one of those principles they talked about in the early chapters. So we're a little bit more conservative on the revenue that we report. And whenever you see one of those things, it's because somebody pushed the rules and was booking revenue and giving huge old discounts for paying within 6 months. You still got that huge old discount. And so their revenue at this period wasn't even close to being right. We don't want our revenues to be overstated. Net sales is the amount we expect to collect from our customers.